3 months ago, I said Super Microcomputer would be a $150 stock. And in the after hours, after the company announced a 10-for-1 stock split, well, I'll certainly see a price lower than $150 here by October on Super Microcomputer. What is going on, investors? Hopefully, you guys are doing well out there. Tell you what, we've got a big one to talk about today. We got Super Microcomputer. Look, over the past year has been one of the hottest companies in the data center, up 74%. Year to date, you're up 114%. But look, over the past 6 months, you've kind of slid sideways, down a little bit, down about 7% on Super Microcomputer. So a lot of the growth has been priced in, and we'll certainly see that from a technical perspective. I'm seeing in the after hours, this thing is bouncing around like a basketball, up 15, 16, 17%, currently up about 5%. The conference call on this one will probably be rather important, but we've got a lot to talk about with Super Microcomputer. We've got that 10-for-1 stock split. Now, first of all, with the 10-for-1 stock split, most of you have seen what has happened with NVIDIA and Broadcom. So there's really no big reason to buy or even sell a stock before a 10-for-1 stock split, other than the fundamentals, other than the technicals, which we'll talk about today. We'll get into the revenue. We'll take a look at the profit. More importantly, this company gave us Q1 guidance as well. So we've got Q1 guidance. We also got full year guidance as well. So they basically gave us 12 months forward on a revenue for Supermicro. We'll compare that to what the expectations were. Now, there is one reason why you might want to buy Super Microcomputer before the 10-for-1 stock split on October 1st. So you've got, about a month and a half, 2 months to make that decision. It's if you own fractional shares of Super Micro. Now, every broker is different. They've gotten better at doing 10-for-1 stock splits on the total number of shares you own, because fractional shares are so popular these days. With Super Micro, I could see somebody owning 1.5 shares or even maybe a half of share. In the past, the brokers would actually cash you out on those partial shares. So let's assume you owned 1.5 shares of Super Micro. They would split the one whole share that you owned 10-for-1 and give you 10 shares of Super Micro, but they would actually automatically sell the half share that you owned at market price on the day of the split, creating in some cases a taxable event. So you might have had profit on that half share. Now all of a sudden you got to pay capital gains taxes and income tax potentially on that gain. And so that's a problem. So I could see if you had 1.5 shares of Super Micro or 1 point something shares or any fractional number of shares, you might want to buy and top up to a full round number of shares before the stock split. Otherwise, you should have seen by now with NVIDIA and with Broadcom, it really doesn't matter. And in a lot of cases, these splits actually make it easier to short the stock and actually create selling pressure, creates a larger number of shares as well, and just creates selling pressure on the stock. And more or less, the fundamentals are going to drive this one forward or down in the future. Now, the fundamentals with Supermicro from a revenue perspective are some of the best that you'll absolutely see on Wall Street. Now, we'll talk about the Q4 here in a moment. We'll go through it in depth. We'll take a look at the $5.3 billion in revenue. They basically met expectations, but one thing that I want to point out with Supermicro is the expectations have just absolutely gotten higher and higher. It's like a superstar athlete that just continues to win and win and win, and the expectations of that athlete get higher and higher compared to maybe athletes that are newer or just don't have that pedigree. So Supermicro has such high expectations because a year ago, Wall Street was only expecting about $2 or $3 billion worth of revenue in a quarter that they just put up 5.3. So they met expectations from the Q4 perspective, but you look out into next quarter, $5.45 billion in revenue. Supermicro are saying, pump that up a little bit, Wall Street. Look at this, folks. $6 to $7 billion in revenue expected. So way, way over above expectations. The high-end estimate was for $6 billion. So their low-end target is higher than the high-end estimate. So I just showed you Wall Street revisions. These are going to go sky high in the next couple of weeks and months ahead as analysts start to catch up with this one. We also got something interesting from the company. They gave us full year 2025. That's 12 months forward for Supermicro. They expect sales $26 billion to $30 billion. Folks, the expectations for next year, look at this number. just $23 billion, or roughly 56% growth. They're going to come way over that. So this company already guiding 26 to 30 on the revenue side next year. That's going to cause all of these subsequent revenue estimates for the next 4 or 5 quarters, like they're going to be way over $5, $6, $7 billion a quarter for the next 3 or 4 quarters. So all of these estimates are going to get revised up. Now, you might wonder, well, why isn't Supermicro up even more? Well, first of all, the stock is up, over the last year, up huge, 74% year to date, up 114%. Some of this results is already priced in. We've got a $35 billion company projecting to about $30 billion in revenue. And some of you are saying, well, that's a low price to sales multiple. The company is basically priced at maybe 1.2, 1.3 times sales, maybe a little higher than that. Well, this company is different, and that is because its gross margins are what I would consider, and most people on Wall Street are actually really, really low. Gross margin is the profit margin that you make off of your net sales minus your cost of goods. If you look at it in NVIDIA, their gross margins are 70% plus. We looked at AMD last week. Their gross margins, I think, are very close to 50%. So when you look at Supermicro's gross margins, last year they were 15.5%. That's already very, very low. Now they've slipped down to 11.2%. So it has some people wondering, yes, this company's revenue growth is very good, but when we come over here and look at operating cash flow, it is actually negative. And then when you look at the balance sheet, given that they have relatively low profit margins, they have to take on a lot of debt and investment in order to finance a lot of their growth. So there's a little bit of a push and pull with this company. It's not your typical chip designer with 60, 70% gross margins like an NVIDIA or like an AMD. It's actually more of kind of a contract manufacturer type margins that you see it maybe like kind of like a Foxconn. $5.3 billion in the most recent quarter. I mean, look, it's just fantastic. Last year, you're at 2.2. If you can maintain this type of revenue growth rate, and this company is certainly kind of guided to it, right? Then shares should be okay, but they do have to make some improvements. Cost of sales in the most recent quarter, $4.7 billion. So I talked about, you had $5.3 billion in sales, $4.7 billion in cost. That gives you gross profit. I'm going to say just about $600 million. Last year it was $371 million. Their profit margin was actually a lot higher last year. Now, you still have research and development. That went from 84 up to 126. Sales and marketing, these things aren't selling themselves, from 31 up to 55. And look at your G&A costs. Boom! From 28 million up to 70 million. So these are your operating expenses. Those went from 144 all the way up to 252. So despite the really rapid, like more than 100% increase in our net sales, look at the impact on your income from operations. It went up. Yes, it did go up, but not dramatically, from 226 to 343. This is not NVIDIA, and I don't think anybody that's buying this kind of expects that it is, but these gross margins, these low gross margins, in fact, shrinking gross margins year over year from 15.5% to 11, 12, it does put a damper on the revenue growth that you can see. And there's a lot of questions on Wall Street. Can Supermicro expand these margins when you have other competition out there? Also, your customer is NVIDIA. NVIDIA is squeezing the necks of suppliers like Supermicro and others in the marketplace. So it's going to be difficult to pull levers to all of a sudden increase these gross margins. And look, for the full year, $1.3 billion or $1.27 billion on the full year profit margins. And now what we can do is start to look forward to next year. The company gave us guidance for 26 to 30 billion. I tell you what, let's just give them credit for 30 billion, but assume that gross margins stay in that 11 to 12%. Well, yes, you will increase your profit year over year from, we'll call that 1.3 up to $3 billion. But again, you still have a company worth $35 billion. You'd be worth 10 times kind of operating income. Wouldn't be wildly overvalued, but Where you would be a year from now with Supermicro is what does the following year look like, 2026? I know we're really looking at this fundamentally, kind of stretching this out a ways, but if the company can't continue its strong revenue growth like it's seen over the past 2 years, if you slip into 2026 and all of a sudden you see slippage on that revenue growth, well, this will be a $150 stock before the split, because there's just not enough meat on the bone with this company when it comes to just those such slim gross margins. It's just not enough meat. Here it is from an operating cash flow perspective. Unfortunately, they only give us kind of a condensed cash flow. So here's your net cash provided by your operating activities. Because this company is constantly buying new inventory from NVIDIA, from other component suppliers to put together the servers, well, they're constantly kind of feeding the beast, if you will. Look at you are negative in the most recent year. Despite the historic results this company has put up, they actually lost, from a cash flow perspective, $2.5 billion of negative cash flow. Now, they plugged the hole by doing financing. They're raising money in the equity and convertible note market. They raised about $4 billion. And I tell you what, these results don't have me overly concerned from a balance sheet perspective, but this isn't Google. This isn't one of these mega giant tech companies. And when you're not, and you have such low gross margins, your cash and cash equivalents at $1.7 billion, not super great. They have a ton of accounts receivable. The kind of people that they're going to be selling these servers to probably have the cash. They have a lot of inventory, certainly compared to last year in 2023, over $4.4 billion in inventory. So they have some kind of prepaid expense, prepaid inventory, if you will, that's already on the books. But they've loaded it up down here with more debt, more term loans, more convertible notes. And so those are things that'll have to come due at a later date. And that certainly could be something that impacts the stock. And I think at the very least puts a lid on the stock. Now, I'm seeing in the after hours, despite these really fantastic results from Supermicro and the guidance, I am seeing the stock slip. I wouldn't put a lot of stock into it. The stock market obviously has been really volatile. That's not breaking any news. In fact, you have this gigantic green candle right here that I had to double check was actually real. This is Monday's candle. You rarely see candles this big and this wide on basically no news. Stock is hovering at its area. You do have overhead resistance on this one technically at 735. I think it's going to be difficult based on these gross margins and the profile of the company for the shares to really want to power up and get any higher than this. That's why my argument 3 months ago with Supermicro was that the path of least resistance was much, much lower. Now, I called this a $150 stock. Certainly after the stock split, that'll come true. But I still hold by my view of this stock in that its results are really, really good now. Certainly 2025 calendar year, 2025, or the next 12 months for Supermicro looks absolutely fantastic. But from a gross margin perspective, I don't think they're giving us any confidence that they'll really expand. And that's basically going to put investors on edge, wondering about 2026. Can they keep the party going? If they can keep the party going, you probably have some performance left in the stock. But I really honestly feel that the good times and the big gains in the stock has already happened. If you were early, you made the gains. If you were early, I would find a stop loss on this one, a profit that you're comfortable with, a profit that you don't want to go under, and set a stop loss and let the computer and the technical sell the stock for you. Otherwise, I think it's going to be a slow drain down with Supermicro Computer as other competitors like Dell and others continue to keep those gross margins in kind of that low double digit, maybe even moving into the single digit range. I don't see NVIDIA cutting their prices anytime soon. I just don't see a tailwind behind this company other than revenue that is going to allow this company to continue to have the outperformance that it's had over the past year. If you were in this one early, pat yourself on the back. Go use that process to find the next winning stock. If you were late to this one, I don't think there's enough meat on this bone right now to buy this one. I would wait for after the stock split. The stock market's under heavy pressure, heavy volatility. stock like this could get absolutely punished, easily back down south of $300 in very, very short order. And if that happens, then there is enough meat on the bone. But at 10 times forward profits next year and 25 times forward current estimates, I just don't think there's enough upside on Super Micro. Let me know down in the comments, and maybe you can change my mind. Hopefully you guys enjoyed today's video. We'll be back again with more. Good luck with your investments.